We are all accustomed to traditional finance nowadays. Most people have a bank account and many of us have borrowed money from a bank. Borrowing and lending are part of our daily life, and this has been the case since money has been in circulation. Finance basically links entities and individuals who have money to invest with people or entities who need to fund a project. In exchange for that money, the investor gets a return in the form of interest or a share in the underlying project. The riskier the project, the higher the expected return. That's a basic principle of finance. In the traditional world, you would use banks or financial institutions as intermediaries to put your money to work. When you put your money in a savings account, the bank remunerates you with interest because your money is put to work. The same goes when you trust an asset manager with your funds. The asset manager will invest your money on your behalf to earn you interest. Conversely, when you need to borrow money, you go to a financial institution to get a loan. You rely on the financial institutions to grant you a loan or invest your money the way you want. Equally, these financial institutions will run background checks on you, calculate a credit score to assess your financial soundness, assess the risk of your project, and so on. Based on this information, they will decide whether to take you as a client. This is why we call it centralized finance. In crypto, a similar system exists. You can also go through a centralized platform to manage your funds, either through borrowing or lending. But as we always say, not your keys, not your tokens. The power of crypto is that you can remove the need for a centralized entity and keep control over your funds at all times. Crypto enables peer-to-peer transactions at a much larger scale than what you could do with fiat. In layman's terms, a peer-to-peer transaction is like borrowing money from a friend or lending money to a friend. You don't have any intermediary and you set your own terms. This is what we call decentralized finance, or DeFi for short. DeFi allows you to interact with individuals all over the world without the need for an intermediary. This seems odd at first because the two reasons you lent money to your friend in the first place are that you know his or her financial soundness and you trust him or her to pay you back. This does not hold with a random person, unless your transaction is secured another way. DeFi has managed to secure that kind of peer-to-peer transaction by leveraging smart contracts on open-source blockchains. In other words, lines of code. Smart contracts automate lending agreements, making it more accessible and efficient for users worldwide. Lenders can deposit tokens into a lending protocol, and borrowers can borrow from that protocol. Yet, this still does not sound that safe for lending money. How could a few lines of code know that the borrower is creditworthy and trustworthy? In most cases, the answer is actually extremely simple: collateral. Bear with us, we will talk about situations when collateral is not required, as it is quite fascinating. First, what is collateral? It is a form of security granted to a lender in exchange for its money. In case something goes wrong, the lender can take ownership of that collateral. You may think you've never had to deal with collateral when you borrowed money from your bank. That could be true. Banks could lend you on an unsecured basis, but you usually pay a hefty interest rate on these loans. But you are also likely to have dealt with a secured loan if you ever borrowed money from a financial institution to purchase your home. That's what your mortgage is all about, a security for the bank in case something goes wrong with your financial situation. Well, collaterals act in a similar way. As a borrower, you're required to deposit tokens as security. The value of the tokens you deposit is directly linked to the amount you can borrow. The protocol calculates a loan-to-value ratio, also called the LTV ratio. Now, we're touching on a critical point of DeFi. We are in the world of crypto, where volatility is king. It is not rare to see significant price movements one way or another, so your tokens that may have been worth $100 could be worth $80 in a matter of minutes. How do we deal with the volatility of the collateral? Protocols usually require over-collateralization. Your LTV ratio will be capped at 80%, for instance. This allows for a 20% price fluctuation in your collateral. But remember, we're borrowing another token, which is also subject to its own price variations. If you do not have a stable coin in this equation, it means you're dealing with volatility on both sides. The collateral value and the borrowed value. Let's take an example. You've got a collateral in stablecoins worth $100 at inception. You borrow Bitcoin at an 80% LTV, so you get $80 worth of Bitcoin. Now Bitcoin's price goes up by 10%. You now owe $88 worth of Bitcoin, and your LTV has dropped to 88%. If you add more stable coins to your collateral, the LTV will drop. The smart contract will trigger a liquidity event as soon as you breach a predefined threshold. It could be 100% LTV, but quite often it is lower than that. The smart contract will basically use your collateral to pay back your loan, and you're left with whatever token you had initially borrowed, and if anything is left, some of your collateral. This ensures the lender is not at risk of losing its funds. Now imagine that your collateral is not a stable coin, but Ethereum. You're now exposed both ways. If Ethereum's price is down 10%, you only have collateral worth 90, meaning your LTV goes up, all other things equal. You now understand why protocols require over-collateralization. It ensures that the borrower is not liquidated for a 1% price movement. The borrower must still manage the position by adding collateral when the LTV gets too close to the liquidation ratio. We haven't mentioned it yet, but borrowers will pay interest on the borrowed amount and lenders will receive interest in return for their liquidity. The interest rates are determined by demand and supply dynamics within the DeFi platform. The higher the demand for a given token and the lower the supply, the higher the interest rate usually is. Interest rates are thus subject to variations regularly. Many strategies exist to benefit from these variable rates, but it would require a lot more time to go through that. We referred earlier to the possibility of borrowing without collateral in DeFi. This may now seem absurd to you. Why would anyone lend money to an unknown person without any security or information on that person? Smart contracts are once again the answer. The specifics of the blockchain allow for flash loans. With a flash loan, a user would borrow funds and repay these funds within the same on-chain transaction. The most common use of these loans is for taking advantage of arbitrage opportunities. Let's say you could buy 10,000 Phoenix with 1 Redix on OshiSwap. At the same time, you could buy 11,000 Phoenix with 1 Redix on Caviar 9. An arbitrage exists. You buy 11,000 Phoenix for 1 Redix on Caviar 9 and sell back 10,000 Phoenix on OshiSwap to get back your 1 Redix. You now have 1,000 Phoenix in your wallet that you got for free, minus the transaction fees naturally. With a flash loan, you could borrow 100 Radix, use them to buy 1.1 million Phoenix on OshiSwap, sell 1 million Phoenix on Caviar 9, and get back the 100 Radix and repay your loan, all within a single transaction. You pocketed 100,000 Phoenix, minus the transaction fees and the interest on the flash loan. With flash loans, borrowers can receive funds that are immediately returned to the lending platform at the end of a single transaction block, or else the entire transaction, including the loan itself, will be reversed. This explains the absence of collateral. There are many other use cases for flash loans. Now, a quick note on the risks related to DeFi. We already touched upon the volatility and the need to monitor any borrowing position to ensure we do not end up liquidated, despite the requirement for over-collateralization. But the key risk with DeFi remains hacks and other exploits. Avoid any platform that did not get its smart contracts audited. That's a basic rule. If the smart contract is vulnerable, users will exploit it, and you may lose your funds. As we've seen, decentralized finance is revolutionizing the way we think about and interact with our money. By cutting out the middleman and leveraging the power of blockchain technology, DeFi offers a more inclusive, transparent, and accessible financial system for everyone. By embracing decentralized finance, we're not just changing the way we manage money. We're building a more equitable and connected world. Thank you for watching. If you enjoyed this video, don't forget to like, subscribe, and hit the notification bell to stay updated with our latest content. Join us on our journey as we explore the exciting world of crypto and the PHNX token.